Chamath Palihapitiya is a Silicon Valley tech entrepreneur, venture capitalist, and social activist who has been making waves in the industry for years. He was born in Sri Lanka in 1976 and immigrated to Canada with his family at a young age. He went on to attend the University of Waterloo, where he earned a degree in electrical engineering. Palihapitiya's professional career began at AOL, where he served as a senior executive, and later on moved on to Facebook, where he was the vice president of user growth and mobile. He left Facebook in 2011 to found his own venture capital firm, Social Capital, which has invested in a number of successful startups, including Slack, Box, and Yammer. Aside from his work in tech, Palihapitiya is also known for his philanthropic efforts. In 2017, he donated $1 million to the Hurricane Harvey Relief Fund and has been an outspoken advocate for criminal justice reform. Palihapitiya is a dynamic and outspoken figure in the tech industry and has been named one of the Time magazine's 100 most influential people in the world. He is also a frequent commentator on business and technology issues and has been featured in numerous publications, including the New York Times and Forbes. In this video, we will be showing you his macro views and what he thinks the future will hold as tech companies continue to rise and how entrepreneurs can go with the rapid flow of changes. Let's check it out.
The biggest thing that's happened in the world today that has caused all of this upheaval that you see has been central banks moving to zero interest rates. Let me just explain this for a moment. If you looked back in the world in the 60s and 70s and 80s, you had incredible coordination. So if there was a big problem, even starting in World War II actually, you had huge problems. You had to invent incredible technologies. There was this cooperation, and it was largely led by governments first. And then all of these other organizations would fall out from beneath it. But that was in a world where the economy was basically one where there were checks and balances, and capitalism was allowed to play itself out. Right? There were winners and there were losers, and we did not shy away from it because that was politically incorrect. Today, that's not true. You are not allowed to have losers. Everybody has to be a winner. Everybody gets to touch the soccer ball. Everybody gets to score a goal. No company should ever go out of business. Every theoretical sector of the economy could be subject to a bailout. And all of that was made possible because when we broke the glass in 2008, in this great financial crisis, we took rates to zero, and instead of taking it back, we abandoned it. And so we stopped cooperating. But what's interesting about that is that that was the same time that technology companies just completely transcended every other company. Because it was a thing where you could still have truth. You cannot hide from the fact that Tesla is a better car. You cannot hide from what an iPhone is. Does anybody know the difference between airline A versus airline B? I'm sure you could give me a very complicated balance sheet example, but there are no differences. You know, pick a CPG company, pick an insurance company, pick a bank. These are all sort of like monolithically the same. Tech companies are not. They are unique. Every single one is unique. Some are winners, some are losers, and it's very clear where the winners are and where the losers are. So what I would basically say is nonprofits and government used to be a very productive way of moving things forward. It doesn't work today in a world of at or near zero rates, or in this world today, the hangover of that. You have to go work in a technology company, and you have to use technology to build a business, because there is no problem that you cannot solve that technology won't be the leading edge of the sword. And by doing it, it's impossible to not make money. I dare you to find a technology business that has improved the world that has not made millionaires and centimillionaires and decamillionaires and billionaires. It's just not possible. So, you know, if you want to be socially progressive and do something interesting, you have to embrace capitalism, and you have to embrace technology, and you have to do something. If you want to really figure it out, I'll give you two big trails of breadcrumbs that you should follow. And I've said this now a little bit redundantly, but I'll just keep saying it because it is the most important thing in the next 25 years. So I don't care what you like or don't like. You need to pivot your career to one of these two things if you want to be successful. Number one is that the marginal cost of energy generation is going to zero. Okay? You have wars, you have death, you have all kinds of geopolitics. that pivot around natural resources and energy. What happens to a peace dividend in the world when you don't have to fight for that stuff because you have abundant energy? And the cost of making that energy is effectively zero, and it has no impact into the ecology of the world. Well, we're about to find that out. And when you take the cost of energy to zero, now it unlocks all kinds of other problems that before were impossible to tackle because it would be too expensive. So that's trend number one. Trend number two is that we have shifted the ability to calculate and solve any computational problem away from a CPU to these things called GPUs and ASICs and FPGAs. That's all fancy language for things are getting easier and easier to solve. Okay, there's a company in Silicon Valley called OpenAI. You may have played with their tools called Wall-E or GPT-3, or DALL-E, sorry, and GPT-3. What are these things? These things are massive leaps in AI, okay? These are models where you can type in something like, and then one of you guys should do it now. We can throw it up here, like, Wharton class of geniuses in the Renaissance style. Those are just words, and they'll translate it into an image. It's incredible, incredible technology, okay? Or GPT-3, where you can have a language model now where it can auto-write a book, and you will not know that the market is a train. And sometimes the train is going up a hill, sometimes the train is going down a hill, and sometimes the train is going off of a cliff. But it's important to observe how the boxcars are arranged. The boxcar at the front are these computer trading algos, okay? And those algos really dictate the early momentum and shape of markets and vol and how things move. Then the next are the hard money long onlys and hedge funds, like us humans that are running money. And then at the back of the train is retail. And I'm just kind of like giving you the three basics, high-level summary. And if you look over and over repeatedly over time, if you follow CTAs and then you follow the positioning of hedge funds, you can sort of see where markets go. And if you take that set of information and you marry it, so you do a join with where the volatility index is, you get a decent directional sense of what's going to happen. Again, this is not advice. This is just like, go and do this research for yourself. Right. I think that people don't understand that a lot of these behaviors were levered to zero interest rates. So if now interest rates are 4 or 5 or 6%, the most important thing as a business leader you should understand is what the implications to your business are. And so, look, I don't know if you saw Google's earnings today. They did a horrible job. And part of it, though, was that they actually released a chart which showed that they had hired an incremental 36,000 people to do such a horrible job. And so they're going to be under a lot of pressure. My friend Brad Gerstner put out a letter to Facebook basically asking them to cut 20% of their staff. It's really important to be financially numerate. And so if you're a good manager of a business and you actually understand that the discount rate actually affects your terminal valuation, which means that there's certain things you can spend on, certain things you can't, and that growing at 50% is actually better than growing at 150% if that 150% growth is unprofitable. Nobody ever thought that that was true. But it's because we never had a rate environment that forced us to learn these lessons. So I think learning these very simple things and just being honest, I find that telling employees, there's been a regime change, here's a new world order, they're smart, they get it. It's like of course, in your family, I'm sure there was a moment where you tried to manipulate your mom for more ice cream. You know what I mean? If you can get away with it, kids do that. Not dissimilarly, I think that employees were able to get away with a lot of excess that was fed by executives in a world where rates were zero and money was infinitely available. And so now we just have to belt tighten. But I think I would learn that lesson very importantly.
During the video, Chamath explains the market by using a metaphor of a train traveling up and down a hill. Additionally, he delves into the impact of discount rates and interest rates on business and startups. Let's tune in to hear more. But before we continue, how are you liking Chamath's idea so far? Do you like it? Or do you have another idea that you think could plausibly be as revolutionary as well? Let's hear it in the comments. We read them. The effect of interest rates is twofold, influencing both startup creation and the economy at large. Capital availability is a critical determinant of startup success, and cutting interest rates can lead to free money that creates headwinds for sustainable success. When capital is spread too thinly over multiple ventures, competition thrives, and talent is diluted, making it difficult for individual companies to succeed. Additionally, during low interest rate environments, input costs like labor and advertising may rise, and the probability of any company succeeding may decrease. Moreover, the market tends to overvalue revenue growth, rewarding it with more incremental enterprise value than it deserves. This can encourage companies to focus on unsustainable growth models and grow at any cost. The outcomes are unfavorable when interest rates change, and it becomes challenging to recover. However, the decreasing marginal cost of energy and computing will likely lead to a wave of new trends. The combination of these two trends opens up new opportunities and possibilities for solving complex problems. As access and scale continue to improve, green shoots are already visible, and the universe will grow exponentially. Lastly, investors must consider boundary conditions when investing in startups. If the trifecta of boundary conditions are met, which includes a new bit platform, a new atom platform, and sustained above average rates, history has shown that it can be a lucrative period for both investors and founders. So, what do you think? Let us know in the comment section below your thoughts. Please give this video a like, as that helps us create more quality content for you like this one. Also, do not forget to subscribe to the channel. That way, you won't miss out when we upload new videos. This is Diversified Streams, and we'll see you on the next one.